Sharpe's optimum portfolio reverse working. Do we all remember the Sharpe's optimal portfolio? May 26, Jan 26 question. Okay, reverse working question. What is this reverse working question? Let us see. Priyanka Rao, CFA, is a senior portfolio analyst at Sundaram Wealth Managers in Chennai. Okay, she has inherited Sharpe's optimum portfolio previously constructed by a colleague who has since left the firm. The colleague's working paper shows the full security universe considered in final portfolio composition, but the market variance and cutoff rate, which were on separate spreadsheet, have been lost due to system crash. Okay, what weird company where the system crashed and these two only are lost. Now, let us come back. Priyanka must reverse derive the missing parameters to validate the portfolio. So far, if you look at our May 26, Jan 26, it was a simple, straightforward, Sharpe's optimal portfolio. This is reverse. I specifically generated a question like this. Okay, I gave AI specific instructions ki boss, ek to do that one portfolio allocation wala question and do one like this. Now, universe of securities considered. There are 5 stocks under Nifty 50, only 5 stocks, not all stocks. A, B, C, D, E, expected return, beta, unsystematic variance. This is available. Then, other known parameters. Risk-free rate is given, expected market return on the market is given. Final portfolio, A, B, C, D and E. D and E are not selected. These are their weights. Okay. Lost data to be reverse derived. Find out market variance, the variance of the market index, cutoff rate, maximum CIs from Sharpe methodology. I am absolutely, I even, when I look at these kind of questions, if such kind of question appears in exam, my first instinct to students is, please look at some other question and come back. I have been telling this for quite some time. I absolutely hate these kind of questions because they don't serve no value in real life. They are very rarely used. Other than asking my AI to generate a question like this, I am not really sure whether they should ask. But however, we don't know how institute will behave. Nobody knows, right? So better at least try one question like this and then move forward. Compute the excess return to beta ratio tenors for each of the securities. Using portfolio weights, reverse derive the cutoff rate from pairwise ratios. Use C star obtained in part 2, reverse derive the market variance. Verify the securities D and D are correctly excluded. Compute the portfolio return, beta, systematic variance, unsystematic portfolio variance. Using CAPM, compute the expected return in Jensen alpha of the portfolio. Comment on manager's performance. Explain briefly in what sense Sharpe's optimal portfolio construction is consistent with CAPM assumptions. We will see. Okay, first of all, we have to remember the formula itself. Formula itself is a nightmare. These are the formulae. Okay, we will look at weights, we will look at cutoff point. It's divided by, there's a line missing there. Market variance into sum of RA minus RF into beta by unsystematic variance. First question, let us get formula, we'll see. Compute the excess return to beta ratio for each of the 5 securities and rank them. Now, what are the 5 securities we have? I'll open the question here. A, B, C, D, E. Expected return, risk-free rate, excess return by then beta, excess return by beta. What is expected return? 21, 15, 12, 10, 8. And what they give as risk-free rate? 6. Excess return is 15, 9, 6, 4, 2. What are betas? 1.5, 1, 0.75, 0.8 and 0.5. So, excess return by beta is 10, 9, 6 by 0.75. This is 8, 4 by 0.8. This is 5, 2 by 0.5 is 4. Excess return by beta. Okay, excess return by beta, this is the order 10, 9, 8, 5, 4. Okay, that is the first part of the question that they asked. Compute the excess return and rank them. Where ranking is very easy. 1, 2, 3, 4, 5. This is the rank. Okay, then using the given portfolio weights, reverse derive the cutoff rate from pairwise ratios of selected securities. What is this here? Reverse derive. Okay, what is the formula first for reverse derivation? This is the formula. If you look at study material also, same formula. Beta by variance into RA minus RF by beta into minus C star. So, what are they saying? What is the specific question? Using pairwise portfolio weights, using portfolio weights, reverse derive the cutoff rate from pairwise ratios of selected securities. So, beta for A, it is 1.5 by market unsystematic variance. What is unsystematic variance? 45, 25, 15, 20, 45, 25, 15, 20 by 45 into return of A 21 minus 6 by beta. 21 minus 6 by beta, you already have this number, into 10, no, this is formula is incorrect here, minus, so I was wondering, kuch to gadbad hai karke, minus C star. So 10 minus C star, okay. For B, 1 divided by, how much is it? 25 into, what is the beta thing? 9 minus C. Then for C, it is 0.75 divided by unsystematic variance of 15, no? 15 into 8 minus C star. Okay. Now we got this value. What we are saying is the weight of this is how much? 40.19%. That implies A by A plus B plus C is equal to 40.19, correct? If you come back to look at the formula, it is simply a weight of each one divided by the total. That 40, this number, this what we have got is 40 point, how much? 19. This 40.19 is what? For A, whatever is the Zi, divided by total of all Zi for all three, A, B and C. So, 1.5 by 45. 0.03. 0.03. So, I will actually simplify each of them. Okay, I will simplify each of them. 0.03 into 10 minus C star into 0.03, 1 by 25. 0.04. 0.04 into 9 minus C star into 0.04. 0.75 by 15. 0.05. 0.05 into 8 minus C star into 0.05. Now we have got this. See, one way to do it is A by A plus B plus C, okay, is equal to 40.19. That's what they gave, right? Other way is A by B or B by C or A by C, anything you can do. So what I am saying is, look at the simpler ones. What is B? B is equal to, what percentage is that? 34.31%. C is equal to how much? 25.5%. Okay. So you see here, this one is an odd number, 0.033. Okay, this is a very odd number. So I don't want to use that odd number. I'll rather use a rounded numbers. So what I'll do, B by C is equal to 34.31 by 25.51, 25.50. I'll solve for this. That is 0.04 into 9 is 0.36. 0.36 minus 0.04 C star divided by, this is how much? 0.05 into 8 is 0.4. 0.4 minus 0.05 C star is equal to 34.31 divided by 25.5. Okay, I will solve for this. Right. So 34.31 divided by 25.5 is 1.3455. 1.3455. Okay. So 0.36 minus 0.04 C by 0.4 minus 0.05 C. This makes life simpler. 0.36 minus 0.04 C is equal to 1.3455 into 0.4 is equal to 0.5382 minus 1.3455 into 0.05 is equal to 0.0673. Okay, C, both places C. So I will move all C's to one side. This is 0.04, this is 0.06. I will bring that here. 0.0673C minus 0.04C is equal to 0.5382 minus 0.36. So 0.0673 minus 0.04 gives me what? 0.0273C or C star, whatever it is, okay, is equal to 0.5382 minus 0.36, 0.1782, or C star is equal to 0.1782 by 0.0273, 0.0273. You get C star is equal to 6.527, so I will take 6.53. Okay, very convoluted, twisted way of doing this. This is done. Using C star above, reverse derive market variance from Sharpe formula applied at the cutoff security. Now, how do you calculate this cutoff? Cutoff ke liye, this is the formula. First of all, you compute CA. And what do you say? Compute the cutoff value at which highest CA is taken as C star. So, highest CA of all these three is C star. Right? The stock whose excess return is above the cutoff are selected and whose ratios are below are rejected. So, the stock whose excess return to risk ratio, which is what? Stock whose Trenner ratio. Where is this Trenner ratio? What we computed? Excess return to beta, excess return to risk, excess return to risk ratio. What is this excess return to risk ratio? Our Trenner formula, right? Beta. So you have to compute Trenner ratio, which we have already computed. Now you have to compute everything using this. This is one hell of a question, man. I just hope nothing so crackpot questions ever turn up for anybody ever. Okay. CI is equal to, what is the formula? Market variance into, I genuinely don't remember the formula. As students, you are supposed to remember. I am not supposed to remember. Sigma 1 to n Ri minus Rf into beta by unsystematic variance, whole thing divided by 1 plus market variance into sum of beta square by unsystematic variance. Now, for each stock we have to compute this. So, for each stock, what will this be? We have to compute first this, and please note this is cumulative. You have to compute it for each one and then cumulate it. So, for the first stock, so we have only selected 3 stocks ABC, rank 1, 2, 3, right. So, for first stock, what will it be? So, for A, B, C, what did we understand? Till C, they are selected. So, meaning till C, what is the C's ratio is 8. This 8 is above your cutoff of 6.5. So, till here you have to cumulate. So, after you do cumulation is when you can equate. So, let us look at each term. Ri minus Rf into beta divided by market unsystematic variance and beta square by unsystematic variance. What is Ra minus Rf? We got it somewhere 1.5, 15 and what was it? 45. So, these two is 15, beta is 1.5, this is 45, correct, no? Ra minus Rf is 15 only, no? 21 minus 6, yes. For B, it is 9 into what is the beta value? Beta value is 1 divided by unsystematic is 25, and here the second part is beta square. Beta is 1 square by unsystematic variance, which is 25. Here beta is 1.5, so it is 2.25 divided by unsystematic risk of 45. For C, it is 12 minus 6, which is 6 into beta. Beta is 0.75 divided by unsystematic risk of 15. And the second term is your beta square. Beta square is 0.75 square divided by unsystematic of 15. Right. So, what do these values come up to? This is 15 into 1.5 divided by 45. This comes to 0.5. Please don't add all of these. 2.25 divided by 45 is 0.05. Okay, please maintain these terms independently. Then 9 by 25 is equal to 0.36, 1 by 25 is 0.04. Then 0.75 into 6 is 4.5, divide by 15 is 0.3, and 0.75 into 0.75 divided by 15 is 0.0375. Now, what is this formula? This formula has to be looked at cumulative level at this particular point. So, cumulative this formula, that is market variance square into summation of all of this. That is where your it crosses C star, right? 0.5 plus 0.36 plus 0.3 divided by 1 plus market variance into summation of all of this, which is 0.05 plus 0.04 plus 0.0375. Okay. So, and this is your cutoff point. Cutoff point is what? 6.5 something we got, 53. So, 0.5 plus 0.36 plus 0.3 is 1.16. 1.16 sigma m square is equal to 6.53 into 1 plus sigma m square into 0.05 plus 0.04 plus 0.0375 to 0.1275. So, you simplify this, 1.16 market variance is equal to 6.53 plus 0.8326 market variance. Okay, so you take this 1.16 minus 0.8326 whole thing into market variance is equal to 6.53. So 1.16 minus 0.8326, that is 0.3274 into market variance is equal to 6.53, or market variance is equal to 6.53 by 0.3274. Market variance is equal to 19.95. Okay, so market variance is this. Now, what have they asked us to find out? These two we have found out using Sharpe or reverse-deriving market variance applied to the security. What a painful exercise. Verified D and E are correctly excluded. Arre babre, why will you have to again exclude? But this is very simple, no? Because their Sharpe is lesser than cutoff. This is very simple. They are not Sharpe, they are trainer. This is super simple. This we need not do anything. D and D excluded from cutoff as trainer less than cutoff. They are excluded from optimal portfolio, not cutoff. From optimal portfolio as trainer less than cutoff. Okay, that is simple. Then is over. Compute portfolio expected return, portfolio beta, systematic variance, unsystematic and total portfolio variance. My God, what is this, man? What sort of horrible question is this? A, B, C. Okay. Weight. What are the weights that they gave? 0.4019, that 40.19 I am writing like this. 0.3431 and 0.2550. These are the weights. This makes it 100%. Then return. What are the returns that we have been given? 21, I think 15 and 12. So, expected return 0.4019 into 21 is equal to M plus, 0.3431 into 15 is equal to M plus, 0.2550 into 12 is equal to M plus. Memory recall 16.646 or 65%. This is okay. Then this is expected return. Then they said beta, right? Beta or expected return, portfolio beta and systematic variance. Beta is equal to, again, beta 1.5, 1 and 0.75. You can again do a multiplication. 0.4019 into 1.5 is equal to M plus, 0.3431 into 1 is equal to m plus, 0.2550 into 0.75 is equal to m plus, memory recall 1.1372. Okay, this is also done. Then what did they say? Portfolio beta, then they said systematic variance. What is systematic variance? Is equal to beta of the portfolio whole square into market variance. Okay, market variance we anyway found it as 19.96. I think it rounded off to 20. Okay, beta of portfolio is 1.1372 square into 19.95. That's equal to 25.80. Then unsystematic is summation of, please remember, weight square into your unsystematic variance. Okay, each weight into unsystematic, then sum. Unsys variance. So, what is the weight? 0.4019 square into unsystematic was 45 plus 0.3431 square. What is the unsystematic? We put it somewhere. 45, 25 and 15. 0.2550 into 15. Okay. So, 0.4019 into 0.4019 into 45 is equal to m plus, 0.3431 into 0.3431 into 25 is equal to m plus, 0.2550 into 0.2550 into 15 is equal to m plus. Memory recall, you get 11.18. So, total variance is equal to 11.18 plus 25.80. 36.99. Habba, 36.99%. What else was unsystematic, total, then okay. Using CAPM compute expected return Jensen alpha of optimal portfolio, comment on manager's performance. CAPM expected return is equal to risk free plus beta into MRP. Risk free is 6% plus beta is 1 point, how much? 13 something, no? 1372 into market return. They said market return some 14 or 12 or some number they gave. Expected market return is 12%. So 12 minus 6 into 6. So 1.1372 into 6 is equal to plus 6 is equal to 12.82. 12.8232 percentage. 12.8232 percentage. Now they have asked to find out using CAPM compute expected return. What is Jensen alpha? Alpha is equal to actual return minus expected return, which is what is the actual return of this particular portfolio bus? Where did they give actual return? So 40.19% into 21 plus, because did we write this anywhere? We got expected return here, no? We got this one, we got 16.65 as the return here, and we got CAPM return. So actual return and this one is CAPM return. So we have to assume actual return, assume Sharpe's return as actual return. So 16.65 minus 12.82 is equal to alpha, that's equal to 3.83. Okay, now this is a super weird question, boss. We got expected return here. We call this as expected. Did they say expected or actual? Why did I do that? Portfolio expected return. So this is portfolio's expected return as per whatever methodology we followed, and the CAPM return based on beta. Okay, explain why Sharpe's portfolio construction is consistent with CAPM assumptions. How is portfolio consistent with CAPM? Consistency. Both use beta and systematic risk. Sharpe's optimal portfolio also considers unsystematic risk. Okay, let us see what is the exact answer A has generated. This is a horrible question, man. I mean, I don't know when I generated it, I never felt this bad. Okay, 1, 2, 3, 4, 5, this was okay. We got 6.535 as C star. How much did we get? 5.3 or something we got. 5.3, okay, one more decimal. Then we got this as 19.95 market variance. We got 20, more rounded number, okay. Verifying they are correctly excluded. Obviously they are correctly excluded because exceeds the cutoff rate. Only if excess return to beta is exceeding the cutoff rate. Then there was another alternative working it is given where you compute cumulative values at each level and after which it starts dropping. At that point is when the C star is there. This is one of the methods in which ICAI steady material has solved this. Then 16.65 portfolio expected return, portfolio beta 1.13 correct. Systematic is 25 correct, unsystematic is 11, both put together is 37. We got 36 something, no? I think rounding of 36.99, yeah. 11.18, 36.99. 11.19, 36.9, minor variation and that should not matter. Then CAPM expected return is we got 12.82, yes, 3.83 we got. Interpretation. The Sharpe's portfolio delivers 3.83 more Jensen alpha, indicating outperforms CAPM by nearly 4%, is meaningful and consistent. Manager effectively identified securities combined is profile is superior to pure market exposure. Okay, then how are they both consistent? Common assumption of market-driven covariance. Sharpe single index model on which optimal portfolio construction rests assumes that all covariance between individual securities flow through their common exposure to market. CAPM is a special case that further assumes markets are in equilibrium and market risk is the only price risk factor. Okay, this is a very lengthy explanation. Both anchor systematic risk to market variance. In Sharpe's model, systematic variance of securities beta square into market variance, and CAPM required return is RF plus beta into RM minus RF, where beta measures sensitivity. Both frameworks price the same risk factor beta. This is what I wrote. Then convergence to market portfolio and equilibrium. If all investors are to construct Sharpe optimal portfolio and if security universe in comprehensive, the aggregate holdings would converge to market portfolio, precisely the tangency portfolio in CAPM CML. Sharpe's model can be viewed as practical algorithm for finding that portfolio. Kuch bhi yaar. Okay, very deep concept. These are all we don't discuss. Distinction remains at diversification level. Sharpe's model explicitly retains unsystematic. This also I wrote systematic, unsystematic, simple. You always assume CA exams you have to give simple explanation. All these fancy explanations are not required. In portfolio construction, following analysis see how much firm specific remains. CAPM is pure, in pure form assumes it is diversified. In practice, Sharpe's model provides a granularity that CAPM extracts away. Both are examined together in question, well constructed, so and so. What is exactly what? So, Sharpe portfolio should exhibit positive alpha relative to CAPM only if the manager has skill in security selection. So, if you select right kind of securities, you will have alpha. Examiner notes what is being tested. Complete mastery of this formula from a reverse derivation angle. They must understand the ZA formula deeply enough to invert it, solve for C star, use observed weights, understand formula deeply to invert for market variance, verify the derivations, integrate with CAPM. This kind of reverse question separates candidates mechanically apply to genuinely understand the model. I don't want this kind of questions to appear, but I wanted to do this just so that you guys are prepared. They try to compute CA forward using assumed market variance rather than reverse deriving. Read the question carefully. If it is unknown, it must come from reverse working. ZI ratio equation requires careful algebra. They drop the beta by market variance factor and treat the equation as ZI is equal to AI minus C star, which is dimensionally wrong. In the CA formula, they confuse which cumulative sums to use, correct? Verify both pairwise and forward CA computation. I don't think forward CA computation we do using two independent verifications in the professional practice divided by ICAI. Bullshit, yeah, this is all not true. Do not confuse Sharpe optimal portfolio with Sharpe ratio, agreed. Reverse working mirrors what junior analysts do in real world. I don't know. When a senior PM hands over complete portfolio, they expect reverse verify each construction to ensure no steps are misinterpreted. This validation is called reverse attribution. The technique is also performance attribution. Tracing a portfolio's ex post outcome back to ex ante. All this is not relevant to us. What is relevant is the question. All this other random shit that AI generates is not relevant to us. What is relevant is only the question, how do you do reverse working? That's all. That is the only element. And here only one point I wish to highlight to you guys. There is this other working which is even more lengthy. But please note, this is the other working is also there in the material. I want to show that to you. So here they said, compute the cutoff, its highest value of CI is taken as C star. The stock whose excess return is above the cutoff is selected and whose ratios below are rejected. Here, the same thing, I think Optimum portfolio 35. So when you see this, right, C star is taken at the highest number, and after it starts dropping, this CI computation, after which starts dropping, this is taken as C star. Sorry, this is 2.81 is taken as T star. I'm sorry, my mistake. The point after which it starts dropping, no, that is taken as C star. If you look at this, 2.814 is taken as C star. Or you can also look at the other one, which is 2.81. So A and F, they both have Trenner ratio which is higher than 2.814. The cutoff, they both, the securities which have Trenner greater than cutoff are considered. So A and F, that is why A and F are considered. Okay, that you can work on both the logics. I wanted to tell you that. Okay, very painful question. I just hope this doesn't come in the exam. Okay, now let us go back to the balance questions. There are no, I don't think I've created or asked AI to create questions which are worse than this. Okay, I think this is the worst question that AI has created in terms of complexity. Okay, let's move to the next one.